welcome in our third session on funds transfer pricing. And today we will cover the objectives of FTP process. We know that there are mainly four main objectives for FTP process to be analyzed. First of all is the management of profitability of different products. So only FTP provides you with some kind of glasses when you can see what is the real profitability of the product. And the reason for this is because sometimes you see the profitability in terms of the all-in rate of the loan, but there are differences between different loans in terms of the riskiness. For example, you may have the loan 5-year fixed term loan, which is consuming liquidity for 5 years. And it's also exposing the bank to the pipeline risk because there is a long pipeline period. So the loan is sitting quite long in the pipeline and therefore is exposing the bank to the pipeline risk, which needs to be by Treasury hedged. Therefore, it is a risky product. Also, you need to allocate additional liquidity because the product is sitting in the pipeline. So you don't know when the customer will draw down the product. You need to be prepared. And imagine the product with, short term, 1 year, straightforward without any embedded optionalities, which is not sitting long in the pipeline. And this product, of course, has less riskiness in comparison to the product which we've just described, 5-year-long product sitting in the pipeline. So FTP needs to differentiate between those two products because FTP, as I said, provides you with this kind of risk assessment. So profitability, yes, but adjusted by riskiness of the product. So also the same is for liability. If you have the liability which is sticky, long-term, good quality liability, you will recognize higher FTP rate because the product is, sticky, is the source of liquidity for longer in comparison to the volatile product, short-term product, which, is, of course, volatile and riskier and has higher impact on your liquidity metrics as well. So it is important that this is exactly, this kind of glasses or the perspective, risk-adjusted performance measurement. And remember, this is one of the most important objectives of the FTP. Of course, we mentioned already the management of the balance sheet and the transfer of interest and liquidity risk from the business unit to a central unit. And again, this is very important because there is clear division between the business units and central unit as far as risk management is concerned. So we need to pass those risks, transfer those risks as much as possible. Not all risks are transferable to the central unit, and we will talk about this later. But majority of risk can be transferred to the central unit through the FTP process. And this is exactly the objective second objective of the FTP. Then you have the product pricing. Loan pricing or product pricing. We will be going through the example of the product pricing in the sessions. And I will show you how to approach the product FTP and all-in pricing on the top of this. However, just here, I wanted to highlight that this is the benchmark. So you have this most important building block in the product pricing is FTP for each product. So already, if you have higher FTP for assets, of course, if you want to maintain your competitiveness in comparison to other products, then of course you have less margin coming because FTP is consuming, a lot of product price, and you have to pay the FTP. FTP on the assets is paid to the central unit. Therefore, you are left with less margin. And last one, which is liquidity management. So the central liquidity management, and we know that even the regulator is requiring in the document, very important document for the bank, for Treasury Department, which is ILAP, Individual Liquidity Assessment Process, Adequacy Assessment Process. And there is a chapter which needs to be provided and written by the bank, which explain how the bank is approaching the FTP in the bank and liquidity transfer price, because of course FTP is covering both interest rate risk and liquidity, so funding. But what a regulator is referring in this document, how are you making sure that you are charging out all liquidity costs for the products which are rising those liquidity costs, both contingent liquidity costs, which are coming from the fact that you have to keep collateral, holding the buffer, not collateral, but holding the buffer for those products in the form of HQLA, high quality liquid asset, or LAB, this is the different term for the same, so liquid asset buffer, and you are holding some portion of liquidity, which sometimes, not when the rates are as now in the situation of high rates environment, but often when the rates are lower or low, you are running the negative cost of carry. Negative cost of carry means that you maintaining this buffer costs you a lot because you are funding the buffer at much higher cost that you are getting back from central bank in terms of the reserve of or government bonds in which you invest the cash. So this is quite important, and regulator wants the bank to charge out all liquidity costs, so both direct liquidity cost and indirect liquidity cost. By indirect liquidity cost, we will be referring in the subsequent sessions. So please keep in mind those terms. The first one is the indirect liquidity cost, or contingent liquidity cost, or call cost of liquidity. This how we will be defining the indirect liquidity cost, because I will show you how to charge out the indirect liquidity cost, and I will be referring to this or contingent liquidity cost or call. Then you have direct liquidity cost. Direct liquidity cost is related to for how long the product is consuming liquidity. And this is driven by liquidity, which is already provided for the loan by Treasury Department to the business unit. And of course, you have to charge the business unit for the price of liquidity. So it is because, again, please remember, in FTP, there is no free meals, which means that if you consume liquidity for 5 years, then you will be charged the 5-year FTP rate for this particular product. Of course, there is a number of different aspects when you're analyzing how to FTP the products, and we will be talking about this in detail in subsequent sessions. Then you will see what I mean. So direct liquidity cost means TLP. You are referring quite often to this component as TLP, so term liquidity premium. Term liquidity premium because it is related to the tenor on the FTP curve, particular tenor of on the FTP curve, which will be charged or recognized, it depends if it's asset or liabilities, to products. So this is very important thing, which I just wanted to make sure in this session. Okay, let's summarize why it is important to transfer risk from business unit to the central unit. And there are several reasons for this. In this process, as already mentioned in the previous sessions, ILM acts as a bank within a bank. And I quite like this term, ILM acting as a bank within a bank, because it's exactly it is showing exactly how this process works. So the central FTP model or maturity matched FTP is working exactly like this, where ILM acts as a bank within a bank, providing liquidity and charging for this liquidity to different units. So first point, why it is important to transfer risk to the central unit? Because it is not the business responsibility or mandate to manage interest rate and liquidity risk on the balance sheet. It is not. It is, they have different knowledge. Those people who are working in the business units, they don't need to know how to hedge the exposure, because their mandate is to work with the customer and to make sure we have growing relationship and the product is of good quality. So they are completely different mandates and responsibilities. Meanwhile, treasury are people who do not face customer, and the thing which they are supposed to do for the bank is to provide the bank with the proactive hedging strategy and proactive funding strategy. So those risks are managed at the best level possible. And then the second point is you want to split, as I said, between the business unit margin and the FTP. So you want to have the price of the product, which is adjusted by the risk profile of this product. As already mentioned, the product, complex product with full of embedded options, or product which have behavioral optionality, it has to be reflected in the FTP. So you will be charging additional portion in terms of the FTP, additional spread, because this product is running additional risk, which Treasury Department has to hedge. Think about this as, Treasury Department agent for the whole balance sheet, and they are entering into the market to provide the bank with the fit and on purpose hedges, which they are not free in the market, especially if we are talking about options. Options are expensive, especially now, and this is quite big effort to pay for those optionalities. Therefore, we are supposed to reflect this cost into the product pricing. How it is done, what decisions are made in the product pricing, this is another story. We will come to that. As a principle, remember that this is the split between FTP and commercial margin. Then we want to have the objectivity. Remember, one of the important things in Treasury and in FTP is transparency. FTP is very emotional concept and emotional topic. And I probably already show you why is that. We have the different P&Ls involved here. P&L on the asset side, P&L on the liability side, P&L in the central unit, which sometimes it is acting as a profit center. Then profitability is obviously very important. And those are, of course, conflicting units, competing units, between them. So you may want to have the benchmark which is transparent, explainable, which everyone knows what is the mechanism, which is not tabula rasa, that no one knows what's there, black box. It has to be very clear how FTP process works and what are the stakeholders, who is making decision, who is responsible for what, and what is the target operational model for FTP. This is why it's so important. And also there is this aspect which I wanted to bring. A business does not have access to the wholesale market, to the, to get funding from wholesale market. It's treasury or capital market, it's treasury. So this is why this is the best, in my view, models which is working, and it is also advocated by the regulator. So regulator is referring to the MMFTP, which is maturity matched funds transfer pricing, which is the central unit. Okay, sometimes just to summarize before we move to another session, quite often I hear the term, is FTP is left pocket, right pocket. So basically it doesn't matter because the P&L of the whole bank is the same. Yeah, it is just the allocation of this P&L between different components of the P&L, which is moving from one to another. But overall, the net interest income, NII, for the bank is the same. It's not really true. It is important. It's true that there is one NII, but if you start underpriced certain products or overpriced another group, and this is wrong in terms, it's not strategic decision, but this is just coming from the wrong FTP framework, you will be driving the detrimental decisions and behavior of the balance sheet. You will start shaping the balance sheet, encouraging wrong behaviors. Imagine the product which is overcharged, of course, will have tendency to be diminishing, reducing, because of course the business unit will say, this product is not profitable. We will focus on the one which is better. Maybe this is instead good quality product which you are made wrong decision and you are overpricing it. Meanwhile, the other one maybe is underpriced, but is the product which maybe is not so profitable. So this is again very important to get the right FTP product, and this is not true that FTP is the right pocket, left pocket. It is supposed to be efficient mechanism. Remember, FTP is mechanism, is the process, it's the number of different processes, procedures, methodologies, frameworks, which are standards, which policies, which are coming into the as the FTP. It's not only one rate, it is much broader than that. So it is a mechanism to charge for funding between asset and liabilities. Yeah, that's a very important definition. Transparent transfer of risk, market and liquidity from business to central unit. It is supposed to benefit a bank, so drive the correct behavior of the balance sheet. It should be integrated with risk reporting and regulatory requirements, and I will show you what does it mean to align the FTP, especially the contingent liquidity cost allocation with the short-term liquidity metrics like LCR or survival horizon. FTP is not to maximize treasury own trading account. It's not to to just optimize, to make focus. We want to get to gain more, because maybe this will provide us with the good reputation in the bank. We are the best profit maker for the bank. It is detrimental for the bank itself. We need to look at the FTP to benefit the whole balance sheet, not the certain business units. And of course, it shouldn't be the tool to hide underperforming products. So if you have the products which is not performing according to your expectation, FTP should show you the fact that this is underperforming product. And if you are making the conscious decision, we want to subsidize the product, and we will be talking about subsidies and different instruments, a mechanism to steer the balance sheet, because you can do it through subsidizing the product as well, or incentive premium. We'll be talking about that later. So it is the tool which should be it should be split, the product FTP after subsidies and FTP before subsidies. And the regulator was very clear, especially PRA in UK was very clear. We want to see what is the real true profitability of the product. So overall, we are talking about performance is the most important decision, but adjusted by the risk profile. Thank you.